Maverick traders, welcome out to your market roundup. It's August 4th. Corey here with you. We're going to take you through meaningful news. We're going to talk about what sectors are heating up, what's cooling off. We're going to highlight our best bullish, neutral, or bearish ideas as we see them.
All trades and analysis in this video are for professional traders only. This video has been released to the public after a delay required by our compliance department. Maverick traders receive this market recap immediately, along with real-time trading support and resources. Maverick Trading is a proprietary trading firm that backs professional stock and options traders with firm capital. Our traders keep 70 to 80% of the profits they generate. If you're ready to become a professional trader, click the apply link in the video description below. Let's break down what happened in the markets today.
So markets came in today to start the week on the right foot. Dow, S&P, NASDAQ, Russell, all up around 1.5% to 2%. Oil lagged a little bit, down 1.5%. Gold slightly higher. This is on the back of jobs data that came out last Friday, and the jobs report suggests that the economy is slowing. Goldman Sachs forecasted growth at only 1% for the last 2 quarters. This is after more robust growth to start the year, and the expectations are that jobs are going to struggle here for a little bit, that there might be more revisions coming. Of course, the head of the BLS got the axe as those numbers missed. So a lot of data coming out, expected to be a little softer than anticipated. Now, why would markets rally on that? You look at the advanced decline line, 80% of stocks went up. The 50-period moving average still bullish, with 62% of stocks above their 50-day moving average. So if we look at the S&P, why would stocks go up today on the back of, just having a horrible jobs number? And I think the answer is all about rates and expectations. So if you think about this swoon, I'm not sure that the sell-off made a ton of sense, given the fact that doesn't a weaker jobs number mean that the Fed is even more likely to cut rates? So remember that President Trump, the economy, if they want rate cuts, then bad jobs data makes it even more likely. The Fed has two mandates, right? A dual mandate, full employment and to keep price stability. So the unemployment rate going up, more people losing jobs or not gaining jobs, that makes the Fed more likely to cut rates. And so I think the markets had a big drop on Friday and then said, well, wait a second, isn't this a little bit of a positive for the rate cutting mode? Now, you can take that one of two ways. It's kind of a rate cut's good if the economy is slowing, getting worse, and so forth. It was kind of a knee-jerk reaction down, and then we bounce back up. And now we find ourselves essentially right at where we were before the jobs data. So the day going into the jobs data, where we finished today, we're right back to even. A lot of volatility, but right back where we started. Now the rubber meets the road. Now we've filled the gap. Two possibilities. Most common is you fill the gap, and then you see a renewed move in the original direction of the gap, which in this case would be to the downside. Obviously, we could fill the gap. We've been in an uptrend overall. Maybe the uptrend wins out. This was just a little dip, a corrective phase, and away we go to the upside. There's something here for everyone, but we're really at that pivotal spot where we have filled this gap. The old gap area, where you gapped from, has been filled. If we keep going or we reverse, it's a point of inflection. And whenever you find an inflection point for a market or an individual stock, that's a nice thing. If you were looking at the NASDAQ, it's the same thing. We're right back to where we gapped from. And now we've got to decide whether this is just going to continue and resume the upward trend, or whether this is just the normal gap down, fill the gap, and then see a renewed move in the original direction of the gap. It's kind of nice because it creates a risk to reward and could go either way. Today's price action would suggest, this is widespread buying. This is buying across a variety of sectors, the biggest names, the most deeply in the green, and the things that are more defensive and stable. Berkshire Hathaway sold off sharply. It reported earnings over the weekend. There was news related to that, but if you look at stability, consumer defensive lagged certainly. The energy sector lagged with oil being down, but the most important sectors, the technology sector, consumer communication services, those were mostly in the green. Let's take a look at a few names to possibly trade. Here we're looking for relative strength or relative weakness if we're anticipating a bearish trade. I've got a couple of charts with this watch list of sorts. The first one on the list is Constellation Energy. So one of the things that we know about large cap tech companies, Apple, Amazon, Meta, Google, all of these companies are going to want to build out their energy needs. And a big way to do that is nuclear energy. So even though this calls itself an energy company, it's really a utility company. It's in the utility sector. Now, it's a little bit more sexy than most stocks in the utility sector because there's a little volatility to this name. Not a ton, but some volatility to it. You can see that it's been in a sideways range and just starting to potentially break out. And the reason that this AI energy build out is so important, I mean, you look at these companies and they're going to spend hundreds of billions of dollars to build out nuclear energy plants and so forth. And that's right in Constellation Energy's bread and butter. That is profits, that is revenues that are coming into a company like this. This company has already signed mega deals with some of those large cap tech companies, and I'd suspect there's more to come. On the technical side, obviously breaking out to the upside. Additional ideas. Here we've got GE. Again, nothing too fancy here. You've consolidated for a little while and just starting to break out above that zone. Each low getting higher than the one before. That's what you like to see, that you set a swing low, then the next swing low is even higher than that, and then the next swing low is higher than that. Kind of an ascending triangle, and away we go to the upside on the breakout. If we were looking at bearish charts and bearish candidates, maybe we'll go to something like PayPal, and here you gap down, but you kept that gap open. I suspect there will be a bounce, and I'm welcoming a bounce of a couple of days, but on that bounce, look for it to roll over again. This one, to me, has the look of an inverse cup and handle type of pattern. Something where basically you've come back down to this breakdown zone. This is exactly where it should bounce for a couple of days and then further selling. But basically, the handle should be about 30% of the size of this. So if we said, well, the bottom of this is around 68-ish and the top of this is around 80, then the range, this cup, is about 12 points in size. And the handle is usually in the neighborhood of about 30% of the size of the cup. So if the cup is 12, 30% of 12 is $3.60. You bounce from 68 and you go up about 360. It puts you just shy of $72 per share, right? It basically will do it a little more scientifically. It would put you at about 3.6 above the 68 zone, would put us at, 71.60. So not quite at 72, right? But right up in there is where I would look to initiate a bearish trade if it sets up. Right about 71 and change. So that's what I'd be looking for. Is this isn't really actionable as much today as if we had a bounce and had a little bit more bounce to it, then I would really like the setup in PayPal. Netflix, here you've got a low base, and is at low bases, it's really a bad sign for the stock, because one would say, well, if you've sold off this hard, even just a mild bounce would carry us back up, kind of like we were talking about PayPal, just a normal little mean reversion, maybe bounce to the moving averages. It's a really bad sign when you're not even strong enough to get any sustained bounce. All you can do is just flatline. There's usually more selling to come. So in the case of Netflix, if I had to put on a trade right here, right now, I'd be more inclined to initiate Netflix. Whereas PayPal looks like it could bounce for a couple of days. Netflix looks like it's just consolidating sideways and getting ready for another drop to the downside. NFLX for a more aggressive downside trade in the shorter term. The uptrend is still intact, but it's certainly more vulnerable. We're at that little inflection point of the gap fill. We've got ISM Services PMI on Tuesday. We've got a big list of earnings: AMD, Caterpillar, Constellation, which we just talked about, ConocoPhillips, Disney, Eli Lilly, McDonald's, Novo, Pfizer, and Uber, not to mention others that we don't have listed here. So stay tuned. Certainly more things to come in terms of earnings and news that way. We're a little bit light on the economic reports this week. Nothing too impactful that way, where we had quite a bit last week with the Fed meeting and jobs. We get a little bit more quiet this week. So with that, I hope you enjoyed the market roundup, and we will see you next time. Goodbye, everyone.